Hello and good morning. Today we will explore a pivotal event in financial history that serves as a reminder of the ethical considerations within software development. In 2012, Knight Capital experienced a catastrophic software glitch, resulting in a staggering $440 million loss in a matter of minutes. The impact was not confined to Knight Capital alone. It reverberated across the market, underscoring the significant role that firms play in maintaining market stability and the ethical responsibility that comes with it. As we navigate through this presentation, we will dissect the incident, its repercussions, and draw crucial lessons for the future. Knight Capital was known for its expertise in institutional sales and electronic trading. By 2012, the company had secured its position as the largest equities trader in the US, handling more than 3.3 billion trades and facilitating over $21 billion in daily transactions. However, on August 1st, 2012, an incident took place which shook the industry to the core and changed the course of history in US markets. A trading error arose from a software bug, and within just 2 days, 75% of Knight Capital's market value was wiped out, destroying the company's net worth and reputation. The firm's development team was deeply engaged in refining SMARS, the Smart Market Access Routing System, which was critical for trade execution. In the midst of this, code refactors were conducted without the crucial step of regression testing. This oversight was compounded by the absence of an automated system to alert the necessity for supervisory review. This left a critical gap in the checks and balances necessary to catch potential errors. In a fateful turn, an engineer at Knight Capital deployed new code in SMARS across 8 servers. However, the new code was not copied to one of the servers. As a consequence, SMARS executed thousands of transactions that bought high and sold low, resulting in financial losses. This incident highlights the critical role that testing, quality assurance, and deployment automation play in software development. The trading error at Knight Capital had profound financial and reputational repercussions on the firm. Let's examine the significant impacts. First, the trading error resulted in a staggering loss of $440 million. This sudden loss triggered a liquidity crisis, causing Knight Capital stock to rapidly plummet. Reputationally, the incident cast a long shadow on the firm, permanently tarnishing its image. Third, customers lost trust in the firm, questioning its financial and operational capacities. Fourth, the U.S. Securities and Exchange Commission, SEC, swiftly responded, filing hefty charges against Knight Capital. Fifth, eventually, Knight Capital was acquired by its rival GetGo, and the whole company was gutted, its assets repurposed. The consequence of this error rippled throughout the entire financial industry. Regulatory bodies intensified their scrutiny on technology and risk management practices within financial institutions. The effects of these regulatory requirements and oversight is profoundly evident in software engineering processes practiced in the financial sector. High-frequency trading firms like Knight Capital play a substantial role in the U.S. equity market, executing approximately 70% of trades. The incident prompted a collective reassessment of technology and risk management practices among these firms. This incident shows the importance of ethics in software development, emphasizing the need for vigilance, accountability, and transparency at every stage of the development process. Now, let's dive deeper into the root cause of this trading error. First, we have inadequate testing. One issue was that the code development had not been sufficiently tested. This meant that the behavior of the code in a live environment was unanticipated. Therefore, an engineer manually deployed the new code, but missed one of the 8 servers. What caused the issue was that there was old, broken code from 9 years ago sitting dormant in this 8th server, which got activated. Second, there was a lack of peer review during the deployment process, and no automated system was in place to alert anyone to potential discrepancies. This lack of a safety net amplified the impact. Third, competitive pressure. Knight Capital's software development team was under pressure to speed up the changes to their trade execution systems. This urgency stemmed from the need to gain a competitive edge in the market. The tight timeline left little room for thorough design, testing, and verification. From an ethical standpoint, the consequences of these factors were far-reaching. The software kept buying stocks long after it should have stopped, resulting in buying stocks at a price that the original buyer never intended to purchase at. While some individuals may have benefited, others suffered significant losses, resulting in an unequal impact on participants in the market. This imbalance challenges the integrity and fairness of the market as a whole. Moreover, there are ethical concerns surrounding the employees who were adversely affected. Such financial losses can lead to job insecurity and personal hardship. In the ACM Code of Ethics, Section 2.2, we find a valuable reminder. Maintain high standards of professional competence, conduct, and ethical practice. This principle resonates deeply. High-quality computing hinges on individuals and teams who shoulder the responsibility for acquiring and maintaining professional competence. In the case of Knight Capital, there was a lapse in this responsibility. The rush to develop and deploy code in the hopes of gaining a competitive edge ultimately led to a catastrophic loss. The aftermath of the Knight Capital trading error triggered a series of significant regulatory responses. First, layoffs. In the wake of the incident, Knight Capital had to grapple with the consequences, including top-level restructuring. This shows the major role that leaders bear in the face of such critical events. Second, losses. This event served as a reminder of how connected financial institutions are with the broader market. It prompted a reevaluation of practices and procedures across the industry. Third, oversight. The issue increased demand for more supervision within automated trading systems. In conclusion, the Knight Capital trading error serves as a powerful testament to the inseparable link between software development and ethics in the financial industry. This incident underscores how critical ethical considerations are at every stage of development, and how a single software glitch can reverberate through individual firms and the entire market. We witnessed the consequences that stem from poor software design, shoddy testing, and missing automation procedures. Furthermore, the regulatory response that followed highlights the indispensable role of oversight in upholding integrity within the financial sector. As future software developers, we inherit a profound responsibility. We must internalize the lessons from this case, emphasizing high quality in every stage of the software engineering lifecycle. There are no shortcuts to success. Thank you.